Good afternoon, everybody, and welcome to the last of UNW's Life After Lockdown webinars. This one's on markets and M&A, and we're really grateful for everyone who's joined us today to listen to what we have to say on these subjects. For those of you who don't know me, my name's John Healey. I'm a corporate finance partner at UNW, and my day job is to help businesses and individuals to buy businesses, to sell businesses, or to raise money to help grow businesses. And I'll be joined later by Steph, who's a colleague of mine in corporate finance, and we're both going to cover the M&A update of this webinar and focusing on what COVID's done to the M&A market, how we see the recovery of the market, and also the shape of deals that are being done at the moment and those that we expect to be done over the next few months or so. And we're really delighted and really grateful to Gareth Lewis from Tilney, who's joining us today as well. Gareth is the Chief Investment Officer of Tilney, Head of Investment Strategy for Tilney, and has been there for a number of years. Tilney are a national business, have an office in the Quayside in Newcastle too. And Gareth's experience before then was 10 years at UBS Wealth in the UK, where he was their CIO. So loads of experience and relevant insight to give us on the markets, and I think dovetails in really nicely to the update that we'll later give on M&A. There's a few housekeeping things here first. What Gareth and I will do, and Steph and I will do as well, is talk for about 40 to 45 minutes in total, probably be in broadcast mode for that length of time. As we go through, if you have any questions, then there's a Q&A button at the bottom of Zoom somewhere that you'll find, where you feel free just to tap in a question, and we'll get to those after we've finished. If you have any technical problems, there's also a chat box function in Zoom as well. So just click on there and type in your technical question, and hopefully somewhere we'll deal with that and hopefully get you back online if that becomes a problem. And then lastly, after we finish this presentation, you'll be sort of redirected to a feedback form. It'd be really grateful if you could take a few minutes to fill that in too. It'll just help us to make sure that when we do these things in the future, we're doing it as well as we can do and make any improvements that we need to. So that's a bit of an introduction from me. I'm going to hand over to Gareth now, who will take you through markets, and you'll be joined a little bit later by Steph and I, who will pick up on the M&A side. So over to you, Gareth.
Well, thank you, John. Good afternoon to everyone, and thank you for joining the call. As John has explained, the purpose of my part of the presentation this afternoon will be to give some sort of high-level perspectives on our thoughts on the COVID-19 pandemic and its longer-term implications for investment markets. The presentation itself will cover off some of our thoughts on the recent rapid recovery in asset prices, but also extend this to cover off some thoughts on the way in which government and central bank policy will reshape the global economy. The presentation itself will fall into three sections. The first will be a sort of retrospective of the events in March and how the lessons we learned during the global financial crisis have helped to explain why asset prices have recovered with the rapidity that they have done. The second will look in more detail at the nature of that recovery. And then the final section will look at some of the longer term repercussions of this and why this combination of government and central bank policy is likely to drive an increase in inflation, currency debasement, and ultimately higher interest rates. So if I just start off by talking in a little bit more detail about the events of March, I think probably everyone on the call is reasonably familiar with what happened. The slide I just had up showed you the headlines in the press. During a period of 30 trading days, the S&P 500 fell by nearly 28%. It was not the largest fall in the history of global stock markets, but it was certainly the most rapid. So on the right-hand side of the chart in front of you, you can see that the speed with which market has experienced, and that general pattern has continued across global markets. Now, one of the things that's quite remarkable about this is not just the speed of the decline, but the speed of the recovery. So from peak to trough was a month, from trough to peak again was another 3 months. And that pattern of trading has never been experienced by any stock market in any period of decline. Now, if you actually look at this and try and seek an explanation, the obvious one is to think it's all about COVID-19, but we actually think that there were some more complex reasons why the market behaved as it did during March. And in helping to understand those events puts context around the recovery we're now experiencing. And the first point, and it may be an obvious one to make, is that investors during March were not actually trading the virus. They were actually trading the response to the virus. And it's quite an important difference. So it wasn't the spread of the virus that created the fall in the markets. It was actually the way in which the governments particularly responded, in the sense of shutting down international travel, closing non-essential retail outlets, imposing curfews. And it was the economic consequence of the lockdowns that created the sell-off. And the second point here is that it was the way in which the central banks responded. So it wasn't just government response that mattered, it was central bank response. And the speed with which the central banks acted in terms of cutting interest rates, monetary stimulus, and effectively backstopping the markets. And it was these two factors that investors were trading. And in understanding that, there is a useful lesson from the global financial crisis. So if we turn the clock back to September 2008 and the failure of Lehman Brothers, there was a broadly 6-month period from that event to the market trough in March 2009. And during that 6-month period, we saw repeated attempts to support the global economy through interest rate cuts, QE programs, asset purchase programs, capital injections. And it wasn't one of those events that created the turn, it was the cumulative weight of those policies. And in this, both then and now, the psychology of investors is absolutely key, because human beings, generally, we tend to conflate action with understanding. So if a big problem arises, we tend to demand a big solution. And if we get to the point where we believe the solution is equal and opposite to the problem we're facing, then we tend to believe that the situation is under control. Back in 2008-9, it took 6 months for the authorities to give that reassurance. During the COVID crisis in March, it took literally 30 days for them to do this. And central banks particularly had learned the lessons of the GFC. They moved very rapidly, and they effectively gave an unsubstantiated commitment to support the global economy. And that's one of the reasons why the markets were able to find a bottom towards the end of March. The second reason is probably more technical, but probably also very important still. And that was the positioning investors were holding going into the COVID lockdowns. So if you think about the preceding 11 years of global investment, it's been an almost uninterrupted bull market. Every time we've had a pullback in asset prices, we've seen greater central bank intervention to support those asset prices. And investors have sort of developed a Pavlovian response where bad news equals more stimulus equals rising asset prices. And the lesson that was certainly learned most recently at the end of 2018, when the Federal Reserve reversed its monetary tightening policies in the face of falling asset prices, meant that investors going into March this year were carrying highly levered, high-risk positions. And when things start to unravel, as they did early in March, investors in these positions have to seek liquidity. And when you're seeking liquidity to meet margin calls, you will sell what you can sell, not what you want to sell. And the events of March really were a rapid unraveling of this levered, high-risk strategies that were held across the piece. And it's no coincidence that the sort of peak of the response in terms of lockdowns and in terms of monetary policy also coincided with the expiry of the March futures and options on the S&P 500, which was the 23rd of March. And that really marks the bottom of this phase. Now, if you actually look at the nature of the recovery now, we're all aware that we've seen a very rapid turnaround in asset prices from that March bottom. We felt at the time that the way in which markets would respond would be sort of in a 3-phase way. So the first one will be the sort of indiscriminate sell-off driven by the need for liquidity. The second one, and the one that we're currently in, is potentially, in our view, the most dangerous, because it can give you the impression of normality, asset prices recover in response to the stimulus that's being provided. That recovery is often driven by the higher beta, low quality companies that have fallen the most. But these are the companies that are actually most in need of the support that central banks and governments are giving. And they're also, therefore, the companies that are most at risk of actually failing as we get to the point where the support systems are withdrawn. And the final phase, which may not be until sometime next year, if not later, will actually be when investors start to discriminate between the good and the bad. They are not worried about capturing short-term mark-to-market movements in share prices. They're actually driven by a desire to preserve their capital and avoid the companies that may fail. So if you look at the sectors that have driven the recovery since the March low, you can see that a lot of these are the sectors that have been most badly impacted by the lockdowns. These are the ones that are most linked to global trade, global manufacturing, cross-border activity. Now, this makes this a relatively low quality rally in our view, in the sense that we could well see many of the companies within these broad industry sectors actually have significant issues with cash flow if trading does not pick up and their debt burdens remain unrefinanced. And so we're slightly cautious about the nature of the recovery. The thing that we need to focus in on in a little bit more detail is the fact that the recovery itself is actually been largely a US phenomena. So the following slide just shows you the performance of the S&P 500, the dark blue line, against the pale blue line, which is the FTSE 100. And there's a material divergence here in performance. The S&P has recovered its post-COVID levels, being unchanged. The FTSE 100 is still down nearly 18% year to date. And that's largely because of what is in the index. And this comes back again to the point about discrimination in what you own and what you want to invest in. Because within the S&P 500, you've got huge concentration in just 4 global tech stocks, Microsoft, Apple, Amazon, Alphabet, and Facebook. They now represent over 21% of the S&P 500 by weight. And if you look back in the history of the S&P, as you can see in front of you, that dwarfs the previous peak of concentration going into the dot-com bubble. If you look at the performance of those stocks, even the worst performing, which is Alphabet, is up over 6% year to date, which is significantly better than any other global index. Microsoft, Apple, Facebook are all up roughly 30%. Amazon is actually up a staggering 65% year to date. And this is obviously because an internet-enabled retailer has flourished in the current environment. But nevertheless, there's huge concentration issues now in the S&P 500. So we need to be aware of the fact that although we talk about a recovery, the recovery has been quite concentrated in the US. And that recovery in itself has been very focused on a small number of stocks. And that underlying this, there are many more stocks and sectors that continue to struggle that have not really recovered with the magnitude that the headline indices would suggest. If you actually then look at why you've got this discrimination, one of the reasons is quite clearly to do with the economic impact on corporate earnings. So there's quite a lot of debate at the moment about the validity of the recovery. The recovery appears to take asset prices or disconnect asset prices from the underlying economic reality of the situation. And if you look at the chart on front of you, that would certainly appear to be the case. So on the left-hand side, you've got the percentage increases in share prices from the trough. Dark blue line again is the US, near 40% recovery across the piece measured by indices. And yet the 12-month forward earnings number, the third set of bars to the right, shows that actually in aggregate, the S&P earnings numbers are likely to be down around 20%. Now within that 20% decline, you've got stocks like Amazon, where the earnings numbers are actually recovering, but you've got many more where the earnings numbers are down 15, 20, 30, and in some cases, particularly in travel and leisure, where the earnings numbers are down 80 or 90%. And it's in this area that we think the big problems around financing and the ability of these companies to remain solvent in the medium term despite central bank action, remains a big issue. So if we actually then look at some of the reasons why the market has recovered and delve into a bit more detail about how these forces will devolve into wider economic repercussions as we move into 2021 and beyond. And the first thing to focus on is the way in which the US Federal Reserve has reacted. So the chart in front of you shows you the progression of the Federal Reserve's balance sheet from the pre-global financial crisis period up to projections for the current year. And what you can see is in the run-up to the Lehman Brothers failure and the GFC, the Fed's balance sheet was running at roughly $1 trillion US. It doubled almost instantly as a result of the events when Lehman's failed into March 2009 to just over $2 trillion. And then over the next 7 or 8 years, it slowly and incrementally increased from 2 and a bit to about 4.2, 4.3 trillion US dollars at its peak before some modest tightening through quantitative tightening policies in 2018. Put that into the context of what they're currently committing to do, and the Fed's balance sheet will double again in the space of 9 months. We're looking at a Fed balance sheet that could exceed $9 trillion by the end of this year. Now, this is a phenomenal level of stimulus, and one which, quite frankly, we have never experienced before, certainly not in terms of magnitude, but like everything else to do with COVID, more particularly in terms of timing, deploying that amount of liquidity to support the US and the global economy in such a short period of time is inevitably going to create significant distortions. And because investors had learnt this sort of Pavlovian response post GFC, where bad news equals more stimulus equals rising asset prices, and the perception that the Federal Reserve have effectively got their backs, that the Fed will do whatever is required to backstop asset prices, investors have been quite prepared to take on higher levels of risk again, to re-lever positions and to drive the markets higher. And one of the things that probably is the most subliminal message behind this that gets scant attention but is very important is the fact that the Fed have extended their actions away from just buying US Treasury bonds and mortgage-backed securities to intervening in the high-yield bond market to actually buy the big companies that were investment grade that have been downgraded to junk bond status. They're even buying these bonds in the market. And when you get to the point where effectively the world central bank is backstopping risk-taking in high-yield bonds, investors are taking a lesson from this, that effectively financial markets are now far too big to be allowed to fail. And they've got the Fed's back, whatever happens. The other aspect of this, and the one where I think the world starts to change as we look forward, is the way that QE and liquidity is going to be deployed. So if you go back to 2008, 2009, most of the post-financial crisis liquidity was used by central banks to buy up bonds, and it was merely used as a financial weapon within monetary markets. Today, it's being used to support governments' fiscal policy. So when any of the governments announce policies designed to support employment or to invest in infrastructure projects, this money is ultimately coming from the bonds being bought by central banks. And this fiscal aspect, it changes things quite significantly, because quite clearly central banks and governments now, faced with the risk that the system clears through higher defaults, are going to deploy whatever they can do to keep businesses afloat. And they're going to do so, if you're the central bank, in the name of trying to keep financial stability. The governments are going to do it to maintain employment levels, and they're going to do it for electioneering purposes. And that changes the whole dynamic of the way in which QE will operate in the world going forward. And it makes quite a significant difference to the way in which asset prices in the longer run will react. And one of the reasons for this is the way in which post-GFC QE has increasingly distorted the distribution of wealth in the developed world. The chart in front of you shows you the distribution of US household wealth. The dark blue line at the bottom is the top 0.1, and it is 0.1% of the US population. The brown line is the bottom 90%. Now, back in 2012-13, these lines converged and crossed. they're now significantly reversed. So the top 0.1% of the US population owns considerably more wealth than the bottom 90%. And we talked about Amazon earlier and the 65% increase in the share price. Jeff Bezos's net wealth went from 10 to 100 billion in the post-global financial crisis period. His net wealth has nearly doubled again despite divorce as a result of this what's happening. But he's only got one vote. And when you actually come to the way in which fiscal policy will be deployed, particularly if you have a change of president in the US, I think a lot more of this will be aimed at Main Street over Wall Street for the first time in 8 or 9 years. And that's a material change. And one of the things that will devolve from this is the way in which interest rates and bond yields are likely to develop. So if you've got greater fiscal policy aimed at Main Street, you're likely to see higher inflation. The big question is, will bond yields and therefore funding rates increase? Well, the likelihood in our view is yes, they will, slowly and inexorably. And if you understand the way in which QE works, you will see that despite what central banks will tell you, interest rates and bond yields actually rise during periods of QE, not fall. The key thing, and it's on the chart in front of you, is that the backdrop through previous bouts of QE has been a deflationary one as a result of banking sector insolvency. But when central banks are printing money and using it, bond yields tend to rise. And there is no reason why we would expect this to be any different this time round, given that at some stage the deflationary consequences of lockdowns will ebb, the fiscal policy will kick in. It's therefore likely that bond yields will rise. Now, rising bond yield is obviously quite a significant impediment to the corporate sector. And one of the areas that we are focusing on more closely than any other is the funding rates in the global corporate sector. And the chart in front of you just shows you the total net debt owned by listed global corporates and the speed with which this has increased. It's now close to $9.5 trillion US dollars. It's actually bigger than the entire Fed's balance sheet. A lot of this is in the US, and sadly, quite a lot of this is actually linked to those companies with weaker free cash flow that have been the beneficiaries of ultra low interest rate policy. So any rise in rates, any rise in bond yields is a potentially very dangerous, consequence. We're not seeing it happen at the moment. I think many of you will have seen the headlines that Alphabet earlier this week managed to raise $100 billion, and it did so at the lowest rates in corporate history, below 2%. Now, you can see how bond yields behaved through the coronavirus crisis with this big spike and subsequent decline. This decline is all to do with government and central bank intervention to drive down yields by buying up bonds. It's probably not sustainable. The fact that Alphabet, who actually have cash on their balance sheet, have raised this debt tells you that they view current interest rates at close to their lows, and they're actually just building up cash, probably in anticipation of higher yields going forward. So in terms of funding rates, I think at some stage during 2021, you will start to see yields rise in bond markets, and the tap of liquidity for the corporate sector starts to get turned off. The final consequence of all of this, and one of the things that we need to bear in mind, is that if you've got a paper-based currency, a fiat currency system, and all your central banks around the world are printing excessive levels of paper money, then stores of value will become increasingly valuable. That actually people will seek something that will retain their buying power, despite the fact that the world is awash with dollars or yen or euros or sterling. And the current chart in front of you simply shows you the way in which investors are reacting to this QE policy through the price of gold and the price of silver. Now, silver obviously is also an industrial metal, so it's going to be significantly more volatile. But the increase in the price of gold to us is not a mistake. This is a response to QE policies and the fact that you are going to see significant levels of currency debasement. So one of the things that the corporate sector needs to focus on very closely, particularly if they do business globally, is how they manage their currency risk over the next couple of years, because I think currency volatility and the devaluation of those currencies where QE is being deployed could actually become quite a material cost to doing business. So before I hand back, just to run through the sort of high-level conclusions. So, from investment perspective, it is our belief that global equity markets are trading the policy response, not the virus. It's the reason why markets remain reasonably sanguine despite the increases in infection rates at the moment. That quite clearly peak response, both in terms of central bank action, government lockdowns, coincided with the end of the March futures and options expiry, which gave us the short-term trough in the markets and allowed the recovery. But the recovery itself is largely predicated not on an improved economic outlook. It's predicated upon the continuing support of central banks particularly, and governments more generally. And the challenge behind this is that, to my mind, the politics of inequality that will drive the way fiscal policy will be deployed over the next 2 or 3 years means that investment markets are likely to not be the same beneficiaries of QE in the future as there have been in the past. And that if you deploy fiscal policy in the way it's likely to be deployed, you are almost inevitably going to see increases in inflation for the first time really in 15 years. And that rise in inflation and excessive liquidity is going to drive up bond yields and funding costs probably over the next 2 years. And the end of the bond bull market probably signals greater strain in the corporate sector and probably rising corporate defaults into the end of 2021. So with that, I have finished my section. I'll pass back and answer any questions at the end if anyone has them.
Excellent. Thank you very much for that, Gareth. I never know whether to listen to those things and feel like there's a land opportunity or I should be incredibly worried. It's probably a combination of them both. But there's a nice crossover between a lot of things that Gareth has said there and the M&A markets. And in my view, it starts with the slides working with the simple principle that the M&A markets tend to follow the economic ones. And there's a graph here I've just pulled up which looks at just UK. Most of the conversations are going to have here are around the UK or occasionally about Europe. But you'll see from that chart there, and it's a squiggly line that I'm focused on at the moment, that the volume of transactions since lockdown started in March has been heavily down on where it was before. And that obviously follows the main markets that Gareth has just pulled up on the screen. It clearly hasn't recovered at the pace that the main indexes have, and obviously very good reasons for that. M&A processes are very often at least 6 months, usually 12 months. They're quite long processes, and to see that level of drop off in such a short space of time, what that means is that acquirers who were very close to signing to buy a business after presumably 6 to 12 months of quite hard work, decided in that window of lockdown and of COVID not to go ahead, and either obviously pulled the process or postponed the process. That's after a lot of effort, a lot of time, and a lot of expense when you start adding up the cost of M&A. So to my mind, what that illustrates is a huge drop of confidence in the corporate and private equity sectors who often acquire businesses, and a real degradation of buyer appetite to acquire. And whether those assets come back on and get completed, we don't know yet. But that drop off in such a short space of time, where people have just decided not to go ahead with something which was ready to go, was quite stark. And it's only caught us, as a corporate finance house who deals with buying and selling of businesses, by surprise. A lot of processes which were either in process, getting started, we decided to pull back on or pause because we're entering such uncertain times. And that's really reflected in the data here, where in that last quarter, transaction volumes were probably less than half, or were less than half of the quarters that preceded it. The value of the overall transactions that were done wasn't a million miles away from the similar time last year. So there were some quite big ticket transactions getting done in that last 3 months, but the volume of activity was much lower. So question I sort of put to myself is, well, those deals that are happening, what's the mix of those deals? What transactions have survived this sort of COVID withdrawal from the M&A market? And the first thing I looked at was how they split across sectors. And what this chart here looks at is the transactions that happened in the first half of 2019, which is the green line, and those that happened in the first half of 2020, which are the blue ones. So The first point to note is that actually all sectors contracted in the UK from a transactional point of view, some more than others, and arguably some hardly at all. But you know that all sectors have been impacted. Those impacted less, probably won't get a prize for saying this, but you know, the more resilient sectors in the UK, financial services definitely, technology clearly quite a big theme at the moment. Telecoms again, you know, all contracted, but by not a huge amount. And those sectors is affected the most. Again, business services, very broad sector, but largely, you know, B2B type businesses. Big contraction there. Big contraction in leisure, almost fell down to no transactions at all. Actually, big transaction in consumer. So really, you can follow common sense there as to which sectors have proved resilient and deals have just got done, albeit less of them, versus those where there's been quite a big contraction in activity. So one part of the puzzle is, well, yes, deals are getting done, they're more resilient, or in the more resilient sectors. The other part I decided to look at was what's happened to pricing for those assets that have transacted and traded. And this graph here it's a busy chart, but it's really it's an interesting one. So the first thing I'll do is just explain what it does and what it says before diving into some of the themes. And this is called the PCPI chart, and it's public company index it stands for. And it looks at the multiples being paid for businesses over a window of time, and it segments that to how much are trade acquirers paying to buy other private businesses, and how much are private equity buyers paying to buy other private businesses, and it has those two elements of pricing to it. It throws out really big multiples. Just for people who don't know, what a multiple is in this context is it's a shortcut for describing the value of a business. Very often businesses are valued on a multiple of their profit or EBITDA, which is a form of profit. And you'll see if you look at any of the metrics around this one, but some good businesses in great markets, high growth might go for sometimes double-digit multiples, so 10 times plus. Then a host of businesses which are probably lower growth or at a different point in their life cycle will normally go for single-digit multiples, whether that's 2 times, 3 times, or 6, 7, 8 times. So there's a range of multiples there that get thrown off from historic transactions. And as a seller of a business, you'll generally obviously try and target a high multiple to get the most value. And so what this looks at firstly is the bars here, which is the green bar is the number of trade activities, so trade buying private businesses, and the blue one is private equity activity. And you'll see actually in the last quarter here, which is Q2 this year, so it's quite current data actually, there's been a big contraction of both of them, which is very consistent with the last couple of slides actually. You'll see that private equity has fallen off a little bit more than trade, but trade's still fallen by over 50% in that last quarter, so big drop in volume, we've already discussed that one. The lines are where it gets more interesting, and just to point out here, you'll draw across the big multiples, you'll see most of these average out at 10 plus or around that area. It really is not reflective of market pricing for selling businesses. What this data picks up is historic profit, which is unadjusted for disclosed transactions, which are generally bigger ones. So I don't want anyone to come away thinking business is definitely worth 10 times plus. I think that's the exception rather than the rule, but the trend's the bit that I'm trying to pull out here. And you'll see from the top line, which is the sort of lighter purple line, which is the FTSE all share, that the average enterprise value to EBITDA of those listed businesses took a big hit in Q1, very consistent with what Gareth was explaining to us earlier, with a recovery going into Q2, but albeit they're still trading at a discount profit from where they were 6 months ago. Just dropping down to the bottom line, which is the trade line. Interestingly, you're seeing between Q1 and Q2 2020, that line's been pretty flat, if not totally flat, which suggests to me that those deals that are being done, which from the previous slide are concerning more resilient businesses that have managed to survive the M&A process to completion, have been done at a non-discounted level, and trade are continuing to pay sensible / consistent pricing for those assets that survive the journey. Now, private equity, which is the darker purple line, which starts in the middle and then falls down, is a really interesting trend. So, the first observation is over the last 12 months, private equity, per this chart, and I would agree with this just based on experience, have been paying more for businesses than trade acquirers have. In some respects, it's a reasonably unhealthy margin. There shouldn't be such a big gap between those two indexes. And the reason that the thing that drives that is private equity have got a lot of money to deploy. What you end up with in certain processes is private equity competing with themselves almost to pay more for a business to end up acquiring it. Granted, they are very, very good when they acquire a business in driving value and ultimately exiting for more. But they've been talking themselves up on price now for some time. I'd say years rather than months. So found themselves really quite outpricing trade on many acquisitions, and you'll see that quite sharp drop in private equity pricing in Q2. But they bring themselves much more into line with trade. And what that sort of shows to me is that a lot of the really frothy deals, the toppy deals that have been happening now for some time, really into quite high double digits on occasion, are the ones that have been pulled off the market, and trade have sort of withdrawn. So private equity have withdrawn from those particular acquisitions. I don't think anyone's going to go gold medal who works in private equity for buying a business for 16 times in the middle of the COVID lockdown. And therefore, I think a lot of those deals have just fallen away. And what you end up with then is less deals being done in resilient sectors, but on pricing which is probably brought down to a more sensible level. And the sort of seller's market that we've been enjoying for some time, you see in the last quarter at least, is starting to become a little bit more of a buyer's market. And is that trend going forward that I guess we're all very interested in? And a lot of my clients, and I'm sure lots of other businesses who aren't my clients actually, would be thinking, we're thinking about selling, we're getting towards the point of wanting to enter into a sale process. We know it takes 6 to 12 months. When do we start in this environment? And what this graph does here is, in some respects, quite interesting. What it looks at is the general consensus opinion of when the M&A markets will recover in volume terms to where we've been enjoying for quite frankly the last 3 years. And the best case scenario there, which again I think is quite consistent with what Gareth's been reporting, particularly in Europe, is that the markets will have recovered by 2022. So actually thinking about selling, well, you could start reasonably next year, maybe in the middle of next year, getting ready for that recovery. Actually, but a more pessimistic, probably more realistic view is that it'll be a longer term recovery, much more similar to the 2007-8-9 post-recession recovery, where actually the M&A markets do improve, but on a more gradual basis. And I don't know, this graph doesn't go out to say when it gets to 2019 levels, but really in the next 3 or 4 years, we'd expect that to recover back. So this graph's an output actually, and therefore I think it's interesting to know what people think about when the markets recover. The key question that I would ask myself is actually, if I'm a business owner, is get all that, get the market back where it should be in 2022, but what do I base my decision upon now about when is the right time to sell my business? So I think there's just 2 things I'd look at there. One is the business performance itself, and the other is the acquire appetite. And those 2 things need to come together to create the most value out of a transaction. Business performance actually is slightly more in people's control. I've got 3 scenarios I'm going to layer on over it here to explain that. This first one here is a really simple, it's just me, I've done myself as you probably see from the second graph actually, a really simple graph that just looks at a business which hasn't been impacted by COVID at all. Every month it's sort of grown, it's ticked on, it's made a bit more profit, unaffected. It's in a sector where the supply chain has not been impacted by COVID and other customer base. And this will be a rare beast in this market. And I say purely from a business perspective there, there's no great reason I could say why that business wouldn't be ready to go into a sale process. All I'd note is that's half the equation. The other half is how a acquirer is feeling and what is their appetite. You may say actually this is exceptional performance in the circumstances. These businesses that haven't been impacted by COVID might find themselves in a bit of a minority, and actually maybe this is a good market to consider a sale, particularly to a private equity audience who are hungry for the right deal at the moment. So that's just one permutation, probably quite rare. This next one's an even rarer one. Businesses that have outperformed in the COVID period, and there are a few of those. We've also talked about Amazon, the Netflixes, the Zooms of the world, lots of technology businesses, lots of supply chain businesses, lots of pharma businesses have actually had a COVID spike in earnings. And I'll be saying there actually, this window now with real overperformance versus where you originally planned could be a good window to explore M&A, whether that's a fundraise at a great value or a disposal. But a couple of these actually, the only thing you've got to be slightly aware of is acquirers or investors are a bit wary of overpaying for a short-term COVID boost. I think it need to be more than this graph is showing you to make that a real premium, i.e. the green line would have to then stay above the purple line for the foreseeable future. Great opportunity for M&A there for those businesses. I think the next one is probably more common. So those businesses that have an earnings contraction throughout the COVID-19 window and are starting to recover now to where they were before. And the really difficult question for that is, given the earnings projection, how do you time a potential exit? And I think there's 2 aspects to that I'll point out. One is how long it takes for the business to trade back to where it was expecting to be before COVID. Question mark how long that is. In this illustration, I've assumed it's about 5 or 6 months to get there. And think from that window on, you can consider a disposal or a fundraise. But the next question is, well, actually, how long do you need to keep trading on that line to prove to an acquirer or an investor that the business is past its COVID dip? And in my view, that would be a minimum of a quarter or 2 quarters just to prove the business has recovered and it's back on track to keep delivering. And all that avoids is this potential for discount that you may get in the market where you've got a formula of multiple times earnings. You want to be showing quite robust earnings that are not COVID affected for a window of time. And this is obviously assuming you have the luxury of the time to wait to trade through this window here. There's ways and means if you don't have that luxury to do it, but I think transaction structures will be more flexible and I think slightly more risk weighted to the acquirer rather than the seller. And Steph will touch on some of those themes shortly. Very quickly, this next part of the equation is acquirer appetite there. Yesterday's market, which is sort of 6 months ago, what it was a seller's market in the main. There's a lot of private equity activity, funding buyouts, funding growth capital, funding buy and build strategies. There's a lot of trade activity as well. You've seen that from the prior graphs of trades buying complementary service provision or end-to-end service provision or taking out competitors from the market. Quite a targeted M&A there. And actually, there's a northeast theme actually, but it represents, I'm sure, the UK as well. A big driver of M&A in the market's been retirement sales. People coming to the end of their journey in a business for one reason or another and choosing to sell to realise value to retire or go into something else. Big theme in the market. And of course, in a seller's market, well, why wouldn't you? Today's very different to that, and the world I hear all the time from all different people is an opportunistic M&A market for acquirers. I think there's a lot who are looking to pick up cheaper assets, maybe stressed, maybe distressed assets, maybe pick up assets from owners who are just battle weary. I think we all feel a bit that way, trying to trade a business through COVID, just almost fed up with it. And therefore, acquirers are opportunistically looking at that as an M&A angle. And that, in my mind, is replacing the theme of retirement sales. It's now about opportunistic acquisitions rather than retirement sales. Private equity are, talk about that in a moment, got a lot of money, want to deploy it, but also got a big focus on their own portfolio and making sure that they're capitalised and can trade. And actually, in today's market, as I mentioned earlier, it's more of a buyer's market. There are exceptions too, and I just thought this is a really interesting chart here, which is of the deals that have been done so far in 2020. You see, there's ever an increasing share of them have got quite a high technology component to them. So that little chart, that will tick up by about 5% in year-to-date 20 on that graph. Is the share of M&A in Europe that's had a tech theme to it, and it's increasing for years and years and years and years. And you can see that in the graph. But you can see how that's almost exponentially increased in the last 6 months or so. Technology businesses, technology-enabled businesses, whether they're sort of software as a service or just businesses that use tech very effectively, are a big and enduring theme of M&A. And of the deals that are being done at the moment, there's an ever-increasing technology component. And it's a theme I just wouldn't ignore if I was a business owner. And if there's an angle there over the next year or two to put a technology spin or to use technology more effectively within a business, I would encourage people to do it, because I just think that this would be really surprising if this graph starts coming down over the next few years. I'd expect it to keep going up. It's just a really in vogue area, and it seems to be justifying quite high pricing on a maintainable level as well. So it's a really interesting theme, and I wouldn't ignore it. And I think I was really interested by that statistic when I came across it. There is a big pool of private equity capital out there, 1.5 trillion, which versus that stimulus probably doesn't sound like a lot, but it is quite a lot of money. It's been there for years. It's still there now. People make their money in private equity, and their jobs are in private equity to buy businesses and to invest in businesses. That won't go away. What I expect is there'll be a big focus on emerging industries like medical, supply chain, connectivity, technology, things I've just mentioned before, and essential industries like healthcare, utilities, distribution, transportation. They're sort of, I guess, COVID proofs, probably one way of describing them, but it's more than that, because COVID hopefully will be a relatively short-term thing, but let's see. I guess the theme is more, they are sustainable and growing businesses in emerging areas, and there were emerging areas before COVID-19, and there'll be emerging areas after. So a big focus of capital in those areas, big focus on distress opportunities as well, trying to pick up things cheap. It goes back to opportunistic M&A again. The bit that's going to hold that back a little bit in pricing is debt availability to support buyouts. Normally this big dry powder that we've got here is matched by bank debt or other debt to sort of leverage it when it goes into businesses. Banks will be a little bit more reserved on toppy M&A and high leverage in this market, so pricing may come down a little bit over the next few months. Corporates again have got money. We've seen raises on the capital markets, which is this sort of 60 billion. It's not as much as was raised in the last financial crisis, so I'd expect it to be a lot more. And a huge amount of government lending, government-supported lending, as I should say, under CBILS and the large equivalent of CBILS as well. So you've got there's a lot of debt in the market. I would be probably too optimistic to suggest that's going to be deployed in M&A. I just don't think that is the case. I think it would be deployed to allow businesses to survive and trade through COVID. But what we might find afterwards is that there is cash there in the system that could be used for M&A when times are better and more predictable. So that might become a theme. But actually, I'd say debt is more of a negative here to M&A than a real positive. I think actually certainly for the next 6-12 months, there's going to be too much risk in deploying a lot of capital on M&A. So that's a bit of a kind of through the markets. Steph's going to pick up from me now and talk about the earlier stage markets, so the fundraising markets and the growth capital markets, which again, I think in the world of COVID are really, really interesting places. So if Steph, you could pick up from there, that'd be great. Thank you.
Thanks, John. So yeah, as John said, he's been talking through the overall M&A market and how activity and value has been impacted. And on the next couple of slides, I'm going to look a bit more specifically at the impact on those companies raising venture and growth capital. So pre-COVID, businesses that were raising venture capital have enjoyed some really strong valuations on their fundraisers. It's been quite a competitive market, and funds have been applying relatively high value multiples to the investee companies' underlying earnings. And just like with the broader M&A, there was an immediate contraction in gross capital activity due to COVID. We can see that on the graph that we've got on screen. You can see that in Q1 there were 1,481 deals, but there were only 784 in Q2 to date. This is a 47% drop in volume. Now, the data for Q2 doesn't include the last 2 weeks of the quarter, but it's unlikely that that's going to make any kind of significant impact. When COVID hit and the UK ended lockdown, funds were initially focused primarily on portfolio triage, so they were looking internally at their own existing investments, how they were being impacted and what they could do to help them through this period of uncertainty. We've also seen that there's been a notable slowdown in new transactions. They haven't stopped completely. Some have still gone ahead, but these tend to have been the ones that were already quite well advanced and in sectors that haven't been as negatively impacted by COVID. The practical issues around physical contact and not being able to hold face-to-face meetings are a bit of a block to this market getting restarted. These funds are investing in and backing the exec team that are behind the business, and if they can't physically meet them, then they're holding back on their investment until they can meet them. So the amount of capital raised has basically followed the same trend as deal volumes. In Q2 to date, 1.86 billion has been raised, which is only around half of that was raised in Q1. The size of the deals has also decreased. So in Q2, the two largest deals were 78 and 79 million respectively, whereas in Q1 we had 4 deals that were over 100 million pounds in size. It is important to note though, when we look at this graph, that 2019 was a really great year for equity investment, and actually Q1 and Q2 were the 2 most lucrative on record for investee companies. So actually the position that we were starting from in 2019 was almost better than normal. And if we look at the growth stage of the companies that have been raising capital, it's really been the established businesses that have suffered the most, and they raised 88% less funding in Q2 of 2020 versus the same period last year, whereas the earlier venture stage businesses actually were able to secure 37% more funding. Now, the Future Fund has been a really welcome initiative to help leverage investment into these high growth early stage businesses. The government initially earmarked 250 million to this fund, but by mid-July they'd committed 468 million across 465 different companies. So you can see how popular it's been. And it has actually been really heavily oversubscribed. I think the latest number of applications were over 780, but it is expected to drive that recovery in early stage cash deployments. And the expectation in the market is that this may actually act as a catalyst for a price correction in the early fundraising arena. Prices will just naturally come down as the market's not as competitive anymore, because there's a lot more companies that are looking to achieve that funding. So there's more demand than before for the same funds. The funds are also being a little bit more cautious as to what they invest in, because everyone has been impacted by COVID. And just briefly on this slide, I'm going to take a little look at where funding is coming from in the Northeast. On the left, we've got a graph that shows the proportion of deals in the Northeast by fund location, the yellow being the same region, the orange being the different region, and blue being based abroad. And on the right-hand side, we're contrasting that with the London picture. So we can see that in the Northeast, since 2018, there's been an increasing rate of investment from Northeast funds into Northeast businesses. And that's actually been the opposite to the trend that's being seen in London. Just to explain the drop between 2017 and 2018 of the funds from the same region. In 2017, the Jeremy Fund ended, and then there's a little bit of a hiatus before the new Northeast Fund was launched, and that didn't actually go live until May 18. So there was a good chunk of period where there was no in-region funding really available. We can also see from the Northeast graph that the Northeast just doesn't receive the same level of overseas investment that London does. So by way of concluding on everything that John and I have just talked through, the way we see the future of M&A is that lots of investors, funders and corporate acquirers are going to be very opportunistic. We've mentioned it before, but the market is becoming more of a buyer's market than a seller's market. There will be more stressed and distressed sales over the next 6 to 12 months. This may present an opportunity to invest at a perceived undervalue, or to consolidate a market position where in a pre-COVID world that opportunity would never have arisen because the business would never have been up for sale at all. From a seller's point of view, those sellers that can will hold back until they have confidence in the market and that the earnings and asset pricing is a bit more, so they'll be able to get the best value for their business. However, there will be some sellers, in particular owner managers, who are just a little bit too nervous about the future uncertainty and will want to exit now, or will look to de-risk their position. And many businesses have seen their earnings contract in the short term due to COVID. And our view, as John mentioned before, is that trading would have to recover to pre-COVID levels for at least 1, but probably 2 quarters to avoid the risk of values being discounted from an earnings perspective. And for any businesses whose performance is tracking the unusual green or purple lines, which John mentioned in his business performance slide, those are the ones that are unaffected by COVID or have actually enhanced their earnings. They wouldn't really need to prove any future growth. They've weathered the COVID storm. But for those businesses, it goes back more to the acquirer appetite and whether they are actively acquiring businesses. And just to complicate things further, there's a possible change to the capital tax regime. A review of CGT is underway, and most commentators are saying that there's likely to be significant changes announced in the autumn budget. We've already seen entrepreneurs' relief reduce. That went from 10 million to 1 million of gains that you can apply the 10% tax relief to. Now, the current headline rate of capital gains tax for most assets and for most people is 20%. And so if that was even just brought in line with the income tax rates, that would really be quite a significant impact. And whilst the market's currently suppressed due to COVID, any significant change in capital gains tax might cause an activity spike as business owners want to sell when they can still take advantage of the relatively benign capital taxes. We've mentioned it a couple of times during the presentation, but M&A activity will differ across sectors. Some will see a much more delayed recovery, and there's other sectors that have been largely unaffected. The tech sector, for example, is a really good one that you can see has weathered the pandemic relatively well. Growth capital and de-risk funders may become more sought after as owner managers want to replace debt with equity and look to de-risk at the same time. So these businesses might be struggling with steep amortization profiles, maybe due to CBILS loans that have been layered on top of the existing lending. And it just ends up stifling the growth of the business. This is where funds like BGF might be a popular choice. And lastly, we've all managed to forget about this one for a few months, but Brexit is still happening. There's not a great deal to say in this, but while there's still no agreement, it just adds an extra element of caution to the M&A market. So COVID has and will continue to impact deal values, processes, and transaction structures. We've mentioned earlier about values being discounted if earnings don't return to the pre-COVID levels. Now, in terms of the structure of that consideration, we think that earnouts are going to be much more commonplace. An Adelshaw Goddard report stated that 25% of transactions in 2019 had a contingent element, and we would expect this proportion to increase going into the future, just because it provides a bridge between buyer and seller expectations, and it also helps to de-risk the buyer in the event that earnings don't actually recover as they expect they would. And of those 2019 transactions that had an earnout, 65% of them was for a 1 to 2 year period. And we may find that actually the length of the earnout period also extends. So you might be looking at possibly 3 year or longer earnout periods. Transaction timelines are likely to lengthen as well, primarily due to the practical restrictions on your face-to-face meetings and document collation. But there might also be more detailed due diligence required because of specific COVID actions taken. So this might be around the treatment of the job retention scheme grants and furloughed staff, or the deferral of the various taxes. Now, if the diligence procedure has been hindered by COVID restrictions, you haven't been able to do it as well as you would normally have, there might be a greater focus on warranties and indemnities. Likely that there will it's likely there'll also be a move away from a lockbox mechanism, whereby the value is fixed at a point in time. This is a very seller-friendly method, and it just puts more risk on the buyer if the situation changes in the lead up to completion. And just one final point is that sellers might also want to consider security for any deferred or earn-out payments, as well as ensuring that there are adequate covenants from the buyer as to how they run the business during that earn-out period, as it's kind of their only protection as to how the business will be run. So that brings us to the end of the presentation. If I get John and Gareth to come back on, and I will run through some questions that have come through. Okay, so first of all, I think I've got one for Gareth. Now I'm intrigued to answer this one as well. How on earth are the UK and other countries going to pay for the bailouts and special schemes?
The honest answer is everyone on this call is going to be paying for an awful lot of it. And the truth is probably a lot will never actually get paid for. So one of the things I think the authorities will be trying to do is drive up inflation rates to try and erode the ultimate level of the debt that's being taken on. They won't say this explicitly, but it's one of the few ways they can manage this situation without significant increase in taxation. But quite clearly, taxation will rise. It may not just be aimed at the individual or the owner managers. It could well be, in my view, aimed at global corporates and particularly international tech. I think there'll be a much greater tightening up of regulations around cross-border taxation. You know, and I highlighted in my presentation the relative performance of the 5 big stocks within the S&P 500. Many of these companies pay very little tax in very many of the jurisdictions in which they operate. And I think they are very easy targets for higher taxation over time. If not, antitrust and breakups could well be the order of the day. But it's going to be a very big problem, much bigger than post-GFC, because the money is being spent by governments. And I suspect that a lot of that government spending will not prove ultimately to be economically viable, that you won't get a proper return on the capital being deployed by governments. So it's going to be much more difficult this time round than it has been post 08.
Okay, thank you. Right, I've got one for you now, John. Someone's asked, what do you see happening to the M&A landscape if there is a second wave or a second lockdown in the UK?
It's a really good question, isn't it? And I guess part of it depends on when that happened. And the best answer I could give would be the graph I presented, where there's a recovery scenario by 2022 and one that just went on for a few more years to an undefined point in 2025, 26, say. It would just give me more confidence that the recovery would be, the M&A recovery at least, would be that much slower and take that much more time. It's such a damaging thing to UK corporates to have to, and obviously society in itself, but UK corporates to trade through another period of lockdown. So I think it would really dampen corporates' ambition to buy businesses, because I do think too many of them would suffer to therefore not be focused on M&A, and you'd probably end up with a market of acquirers, which is a few selected businesses and corporates who have done okay through 2 lockdowns, and private equity, but probably not an awful lot in between there. So I just think the effect it would have on acquirer confidence would be pretty significant, depending upon, I guess, the length of the lockdown, the magnitude of it, and what government support is available throughout that second window if we get to it. But I'm afraid I think that'd be quite a damaging thing to M&A for a while, I would have thought.
Okay. And we've got the final question. Again, this is one for you, Gareth. Owners of capital are still doing better than employees. Wages are down and share prices are up. How sustainable is this?
Well, it isn't sustainable ultimately, and I think one of the things that will change in a post-COVID world is the desire of governments to use access to fiscal policy to try and redress that. The problem that the world faced post-global financial crisis was most of the remedies to banking sector insolvency ended up passing significant amounts of the benefit to the owners of capital. We talked about the increase in Jeff Bezos's wealth earlier in the presentation. That is by no means unusual, and the share of wealth that's been accumulated by the very, very tiny number of people at the top of society is actually, in my view, societally unsustainable. Politicians now have some firepower to deal with this, and if you start to see bond buying activities of central banks used by governments to fund infrastructure investments in poorer parts of the country, to encourage greater training initiatives, all of the things that you would expect in a more broad and open-minded economic response, will take a lot of the benefit away from the Wall Street idea to Main Street and the wider population. So I actually think there are some positives in the longer run that will come out of COVID. I think it will be an extremely unpleasant period over the next couple of years economically, but in the longer run, you are likely to see a more equitable distribution of wealth as a consequence than we've seen in the last 7 or 8 years. Okay,
fab, thank you. So if anyone does think of a question after the presentation, please get in touch. Our contact details are on screen alongside Anthony Field, who is Tilney's local northeast based contact. Since the middle of May, we've had several of these webinars covering topics such as grants, VAT, employment taxes, accounting standards and cash planning. These can all be watched on the news page on our website, and one of my colleagues is going to pop a link into the chat box that takes you to that page if you're interested. Just a final reminder that after you exit the webinar, you'll be redirected to our survey. As this is the last in our series, we would be grateful if we could get your feedback, and it does help shape our events programme going forward. Finally, thanks to everyone who joined us today, and thanks again to Gareth and the Tilney team for taking part in this with us today. Thanks everyone.
Thank you everyone.